Wall Street has had a lot to celebrate over the past few months. The stock market was hit record highs, and with a wave of deregulation already in the works in Washington, more boom times could be just over the horizon. But are today's bull markets just a mirage? Or even worse, are they a sign that the next crash is already on its way? Joining me now is Dr. Richard Wolff, visiting professor at the New School, co-founder of Democracy at Work, and the author of numerous books, including Capitalism's Crisis Deepens, Essays on the Global Economic Meltdown. Professor Wolff, welcome back.
Thank you, Tom. Glad to be here.
Always great having you with us. So, as I mentioned, stocks have reached record highs in recent months. The Dow Jones went over 20,000 for the first time ever. What's going on here? Is it Trump?
Absolutely. It's Mr. Trump promising the moon to investors and wealthy people, promising them that they will have lower taxes, that they will have a deregulated opportunity to make even more money than they've made in the past, doing what the Republicans and the conservatives have wanted, promising to do it with, if anything, even more gusto and enthusiasm than they've had. And as long as he can keep that game going, keep that belief supported, then people are going to invest money hoping to cash in, even though the people on Wall Street themselves know that this is all based on hope and hype, and that no one can be sure that this will not turn out to be, as you put it, another prelude to another crash.
Wow. Well, in capitalism, like in physics, you know, the old saying, things that go up must come down. I'm sorry.
There's another way to get at this, actually, because the history of capitalism has been that there have been periodic downturns. And the average length of time for a downturn to occur between one downturn and the next is 4 to 7 years. Okay, we'll do the math. The last major downturn we had, 2008, 2009. 4 to 7 years means we're kind of due for one. It doesn't mean that it can't take a little bit longer, but you would be very foolhardy to deal with a system like ours that has had this regular downturn every 4 to 7 years to imagine now, when it is long in the tooth, when it is very highly hyped since the election, that you aren't really cruising for a proverbial bruising in this stock market. And there are already lots of signs that investors are hedging their bets.
You said that one of the reasons that the market has been going up is because Trump has been promising the moon to wealthy people and investors who are the principal owners of stock in the United States.
Right.
At what point, what do you think it will take to puncture that illusion of competence, the illusion of the ability to get things done? I mean, we're looking right now at this whole repeal and replace Obamacare thing imploding right in front of us. You've got the conservative Republicans hating it, and then you've got pragmatic Republicans hating it, and it's basically just the ideologues or the people who are perpetuating the falsehood that Obamacare was doomed to fail. Kind of stuck with eight years of a lie. Could that be enough to take it down when that blows up? It cause people to lose confidence in his ability to get things done?
I think it could. I think it already is beginning to do that, because what would puncture this balloon is any strong feeling that he will be, that is Trump, unable to actually achieve the deregulation, the cut in taxes, and so on. That there will either be dissension in the Republican ranks, what has already shown up in the Affordable Care repeal business, or there'll be opposition from the Democrats, or there'll be opposition in the streets, or some combination of those. If you get the sense on Wall Street that this man cannot deliver the extraordinary promises he's made, then you're going to see a withdrawal from the stock market that could be very harsh and very fast and cut very deep.
Do all these stock market records actually mean anything for the vast majority of working Americans? And if so, why or why not?
No, they basically don't. The Wall Street is a gambling casino. It's based on hype, on expectations of the future. It has to do with how much money you think you can get for selling a stock next year that you bought this year, or next month that you bought this month. It has some relationship with the underlying economy, but it has a freedom to go in every which way, which is why phrases like exaggerated exuberance or irresponsible investing or casino capitalism, why these phrases keep being invented by people. It can go in any kind of direction. Remember that it's not really only about the American economy. Foreigners bring their money to New York to invest in the stock market if their economies are either dangerous or shrinking. We've had a good benefit of that. Should that turn around? Should the Chinese recovery get going? Should Europe get into better shape? You'll see money leaving and the stock market here going down, independent of what's happening here in the United States, because of the larger considerations that rich people who are globalized now use in making their decisions. So the connection is an attenuated one.
So it sounds like that's actually generative, that, you know, as more people put money into the market goes up, which causes more people to want to put money into the market. Now, the reverse would also be the case. It hadn't occurred to me that it might go down if China or Germany's economies improved. I thought if their economies got worse, that people might need to pull the money out of the U.S. stock market in order to cover margin calls and things like that in their own country, or just pay their expenses in their own country. In either case, though, how much leverage is foreign money representing in Wall Street? Is this a big factor, a small factor? And if it gets started in a downward spiral for any one of several reasons, how far do you expect it to go?
Well, the first answer is yes, it's a big factor, especially when you remember it doesn't take all that much to start a stampede. If anybody, Chinese, German, European, Latin American, if any significant number, even if it's small, of investors begin to pull out, then every other investor has to ask himself or herself that great question. Do I stay in because I think this will be a momentary blip, or do I have to get my money out before the big crash comes? Remember, the crazy psychology is today, and I know many of these people, they're investing in the stock market not because they believe it, but because their competition with one another means that so long as the hype is believed, they have to participate in it to make the money. The trick is to get out before the reverse begins to happen. And when that happens, when the foreigners or the domestics who begin to get frightened about Mr. Trump not delivering, well, then you could see that kind of withdrawal become a spiral, a self-reinforcing spiral, and then you see the kind of literal collapse that we had, for example, in the last 4 months of 2008, when the stock market just went into a complete tailspin and trillions were lost in a matter of weeks.
Yeah, remarkable. It seems increasingly likely that the Federal Reserve, is going to raise interest rates sometime this month. At least Janet Yellen all but said that. What would be the significance of a rate hike? What kind of an effect would it have on the economy? Why should the average person care?
Well, it could have an effect. You know, it's a gamble. And I think that the people in the Fed want to raise interest rates because we've expanded the monetary supply so enormously over recent years that there's this anxiety of this overhang of vast amounts of money that could generate an inflation. Hasn't done it yet, but it could. And so there's a sense, let's start building the barriers to that happening. But the great fear in our capitalist economy is that if you raise interest rates, making it more expensive for businesses to borrow, for individuals to borrow, that's going to lead to a cutback in spending, and that could drive the economy down. It's kind of a knife-edge situation, and the Federal Reserve doesn't want to be the agent that we will look back on 6 months from now to say, you raised the interest rates when it wasn't really safe to to do so and plunge the economy into a recession. And with a president like Mr. Trump, were that to happen, he will blame the Federal Reserve in order to avoid getting the blame on him, and we know how he does that. So this would then become a polarizing situation, and that's why the folks in Washington are very scared, at least those that have responsibility in these areas.
Well, doesn't that also imply that the only reason the market is as high as it is right now is because the Fed has been jacking money into the economy?
The Fed has been jacking money at the same time that the president now is a person who promises the moon. Deregulation, make all the money you want. We won't tax you the way we did in the past. We're going to muscle our way around the world to give you advantages left, right, and center. We're going to have an explosion in the military to protect you, whatever you do, wherever you do it. These are heady commitments. Put that together with a flood of money, which, by the way, doesn't go into investing in real production because it isn't safe for businesses to do it. So it goes into the stock market and builds this hype up. So if I were an advisor in Washington, yes, I would be saying to all kinds of people, be very, very cautious about your investment because you could be sitting on a disaster. And the very fact that I say that means others are saying it, which means that right below the surface is a kind of anxiety which could become a really death spiral for a stock market boom that is built on so little in the way of a real foundation.
We just have 20 seconds or so, Professor Wolff. How far down would the market go before you would consider it a rational correction versus a disaster?
A rational correction is usually 5 to 10%. Everybody breathes more easily. A lot of money is lost, but you feel you're okay. If it goes much beyond that, 15%, 20%, you're going to see secondary effects of this crisis that begin to play themselves out in the larger economy. Then there will be no discussion of raising interest rates. We'll go back into the crisis mode 2008, 2009, and we'll have another series of bailouts. And nobody can tell whether this president, under these circumstances, can pull that off.
Dr. Richard Wolff, thank you so much for being with us tonight.